Hello everyone. Hello everyone. So today we are going to do sort of a stock review or analysis of this stock, Star Health and Allied Insurance Company Limited. It is an Indian private health insurance company listed on the National Stock Exchange (NSE), uh, which is the second biggest exchange in India. So yeah, let's go ahead. Just a minute. Yeah, so let's begin analysis. Right. So Star Health and Allied Insurance, as we can see, is India's first standalone health insurance provider and is also the largest private health insurer with a market share of 16%. I remember its market share was around 30%, I guess, 2 or 3 years back. Uh, I'm not sure, but I'm pretty sure that the market share of Star Health is dwindling quite fast as new players enter this private health insurance market, right? Another listed player, which is also this a standalone health insurance provider, is Niva Bupa, which you might have heard IPO'd a few months back, right? So yeah, these two are the listed companies in this space. Anyways, this is my personalized sort of list of ratios which I like to take a look at whenever I'm interested in a company, right? So the market cap of Star Health is 27,000 crore. Now, basically, it's a small cap company at this point, right? So it does have a good growth potential. Not just because it's in the small cap sector per se, but the space itself, right? Health insurance is quite under penetrated sector in India as such, right? There are not most people in India don't really are aware about, let alone buying a private health insurance, right? Because we have quite a socialized system of healthcare where government itself is the biggest provider of cheap or rather free of cost healthcare to the majority of public, right? So most people don't really feel the need to pay for or buy a private health insurance. But as the country progresses, as we embrace capitalism, and there's widespread medical inflation, people do feel the need to pay for a health insurance so that they don't have to, get shocked with their medical bills out of nowhere if unfortunately some sort of illness happens in the family, right? So that's sort of the basic premise that why health insurance is a growing industry. And it's not just a hunch that it's a growing industry, it's actually a growing industry. If we take a look at the top line of Star Health Insurance, it's actually growing quite fast, right? Like if you see in 2016, 17, 18, it has like 40%, 20, 26%, 43, 30, like nearly 30 to 40% growth year on year was the norm, right? The and then post COVID era also, if you look at 23 FY 23, 24, 25, it has shown a good growth of around 15% every year, right? This is the top line of the company. For health insurance providers, the top line basically means it's not revenue, right? They are not selling a product per se, they are selling an insurance. So for health insurance company, the sales figure basically tells you the gross written premium, which is also known as the GWP, right? The total premium, insurance premium, which the company has written over the entire financial year, right? So that is taken as the gross written premium, and that becomes the revenue itself for the company. So there's that. Then the stock is currently trading at rupees 463 per share. I recommended this stock on my X slash Twitter account when it was trading at a price of 350. With the market crash, it went further below, it dipped further to make a low of 327, and finally, it has given a big jump from 350, at which I give the call. It is now trading at rupees 463. So that's a jump of about rupees 113 per share. That's translates to around 33% return in just about a period of 1 or 2 months, right? So that's an insane return actually. Yeah. So around in 8 May, around in April itself, the stock was at about 350. Then it went near, then it touched 400, and in May it dipped back, right? This 9th April dip was due to the Trump Liberation Day tariffs, right? And they caused a dip in the global equity markets. Indian market already had sort of it was already sort of in a bearish phase, so it dipped even harder. And so the stock was trading at 350. Temporarily it reached 400, but then dipped again back to around 350 levels, and now it has shown a V-shaped recovery, right? So this is sort of the story. Star Health. Yes. So now there are some ratios here: return on capital employed, return on equity, return on invested capital, return on assets. These four are quite important ratios. Particularly this the return on invested capital and the return on equity. These are okay. Oh, sorry. Yeah. So the return on invested capital and return on equity. These are the two most important ratios, which you must always look for. When you are trying to gauge the when you're trying to have a gauge of the profitability of the company, right? So these two ratios ideally should be in the 10 to 20%, right? It's a good round figure to have, and if it's above 15%, above 15%, around 20%, then it's and usually the company is profitable, right? That suggests that the company is profitable. Below 10% is sort of low profitability, and the idea is basically that the return on invested capital should be more than the risk free rate of return. The risk free rate of return for Indian companies more or less is the 10-year bond yield, right? Indian government 10-year bond yield, or some people can take the 30-year bond yield. Whichever way you take, I usually feel that the 10-year bond yield is better suited, because most of our DCF valuations, the intrinsic DCF based valuations, we do for the next 10-year period. So bond yield also should be taken for the 10-year period only, rather than taking the long term 30-year bond yield. So the 10-year Indian bond yield is around 6.25% as of now, if I remember correctly. So 6.25 is the absolute risk-free return rate, right? So the return on invested capital has to be greater than 6.25% as of now, so as to so that investing into that company makes sense, right? The company itself is doing a good job with the capital invested in it, both via debt and via equity. If the company is earning less than the risk free rate of return, then what's even the point of doing the business? They can just take all the money and dump it into the Indian government bonds and earn a risk free return of 6.25%. They are doing a business, they are taking a risk for the sole purpose of beating this risk free rate of return, right? They are taking a risk so that they can beat that 6.25%. So anyways, coming back to the discussion here, with our company is trading at, our company is giving a ROIC of about 12%. So that's good enough. That's not great, but it's good, right? Now the earning per share is 11 now. As compared to the price of the stock, the earning is quite low, as is reflected in the price to earning ratio of about 42. Now don't get scared by saying that this company has a high price to earning ratio, since this private health insurance, as we talked about, is a growing industry, right? It's a the penetration is quite low. So if the service succeeds as such, it gets popular, which it inevitably will. The question is which of the players will become the dominant players 10 years down the line. That one question is sure, that the health insurance sector is going to see a boom. Now, whether out of this boom, who benefits the most, that remains to be seen. Whether Star Health is able to maintain its market dominance, the huge market share, not huge, but the biggest market share. It's just 16%. It's a big share, but it's not huge per se, not 30, 40, 50% of the market, but still, it is the market leader for all practical purposes. So, whether it's able to maintain that sort of dominance in the coming decade, that will decide whether Star Health lives up to its story of a growth stock, right? So, coming back to this discussion, we said that the health insurance sector is a growing industry and in a growth. So this is a growth stock, and in growth stocks, it's okay to have a high price to earning ratio, right? If you look at US stock markets, the Mag 7 stocks, particularly Tesla, Palantir, these companies have too much too much of the growth potential priced into their stock, so much so that their price to earning ratios are like 60, 70, 80, sometimes even more than 100, right? There was a point when Tesla was used to trade at a price to earning ratio of 300, I guess, if I'm not wrong. So anything can happen, right? Markets can be irrational for longer than you can be solvent. So that's the point. Don't trade purely on the basis of price to earning ratio. People can attach a lot of growth potential to a company, whether it's rational, whether it's rational. It's not for us to decide, right? It's for the market to decide. We can just, you know, make our own opinion about it and decide whether to invest or not. So as of now, I think price to earning of 42 is not a big concern. The company is showing good growth. If the company is not able to show growth year on year, then we might think that the company is overpriced. But as of now, a price to earning ratio of 42 looks good. Yeah. So coming back to our discussion, we talked about the price to earning ratio, the profitability. Now we need to see the price to sales. So this price to sales ratio is sort of underrated in my opinion. Very few people actually take a look at the price to sales ratio, right? Everyone has just sees the price to earning ratio, and if it's low, they think the company is good, they buy the company, and if it's high, the company is bad. It doesn't work like that. For a growth company, even a high PE is good, and for a, a stale company sort of which is showing no growth, even a low price to earning doesn't mean that the company is a good investment if the company is not showing growth at all, right? So there is that. Right. So more important than price to earning ratio, I feel, is price to sales ratio. So price to sales ratio is basically the market cap of the company upon the revenue divided by the revenue of the company in the latest financial year. Market cap to the sales in the latest financial year, or the trailing 12 months, whatever you feel is more accurate. That is what counts as the price to sales ratio, right? So no, I had made a. So this was the preliminary discussion which needed to do, which needed to cover when talking about Star Health Insurance. Mm, Now, also the operating profit margin of the company is sort of low, 5.27%, but it's a financial company, insurance-based company, so a low operating profitability is sort of expected, right? Now, okay, another important thing which you can see here is the median price to earning ratio. What's the price to earning ratio itself is not that important. It's sort of overrated. A lot of people assign too much importance to it, but the more important ratio than price to earning is price to sales, definitely. What's important in price to earning is per se is the median PE, right? The median PE, I feel, is the most important ratio. So the company was listed in 23, it appears, right? So the median PE is 41. The median PE is 41 and the current price to earning ratio is 42.1. So company has quite maintained that stability around the median PE. It tipped lower for the last 6 months, but now is again back to its median price to earning ratio. Okay. Shareholding pattern is also, kind of gives a lot of good information. So as you can see that over years, okay, that's interesting. Since in the last 1 year, FI has have sold their position of about how much? 7.5, around 8%. Yes, around 8%. They have sold their stake in the company. That's a big sell. Also, the promoters have reduced their stake. The DIIs have increased their stake to about 4.3%. The public, the retail has been a big buyer during this period. Anyways, it seems the retail has been proven right, I guess. Or another way to look at it is that due to the selling by the institutions, the FI, the foreign institutions, and the promoters, the stock dipped much below its median PE over the last financial year. Right, the retail kept buying at these lower levels, and now when the stock is back at its median PE level, it remains to be seen what's the course it takes now over the next 6 months, next year, next 2 years, right? So that's what our area of interest is. Anyway, so I had prepared a worksheet in order to analyze this Star Health Insurance stock. Let's take a look. Uh, yes. So let's first understand the standalone health insurance business, right? So to understand Star Health stock, what this company does, we have to get a good grasp of what the standalone health insurance, what private health insurance business is all about. So insurance sector can generally be divided as life insurers and non-life insurers. 1 minute, yeah, I will be back. Yeah, so insurance sector can generally be divided as life and non-life insurers. Non-life insurers again can be, general insurers and standalone health insurers, right? Now general insurance sell multiple products like fire insurance, crop insurance, right? Fire insurance for buildings and, commercial buildings, stores, apartments, whatever. Crop insurance is used by the farmers for their crop. Motor vehicle insurance, we all know, right? The third party vehicle insurance and all sorts of insurance related to automobiles. And then there is health insurance. These are general insurance products, right? Health insurance also is a part of general insurance products. Then there is uh, the standalone health insurers, right? So the life insurance, which we know, Life Insurance Company of India, LIC, they sell life insurance. That's a whole different product, right? We are not going to discuss what life insurance is, how it works. What we are remitting our discussion is to non-life insurance, and even in non-life insurance, we are not going to talk about fire, crop, motor, etc. We are just going to dive deep into the standalone health insurers, SAHIs, which sell only the health insurance, right? So Star Health is basically a private sector company, private sector retail company which is focused on the Sahi space, standalone health insurance space. And interestingly, it was founded by the retired managing director of United Health Group to start his own health venture as Star. So that's interesting. United Health Group, if you know, is the largest healthcare company in the world, and not just healthcare company. It is like one of it's like in the top 5 companies in the listed companies by the market cap, if I'm not wrong. Let me check. So So United Health market cap is around 268 billion. The stock has quite a had recently quite a big fall of about 15 to 20% due to some sort of the United States Department of Justice starting an investigation into this company. But before that, I guess its market cap was above 400 billion. I guess if I'm not wrong. So recently it has seen a big dip, but before that it was um, yeah, you can see it had a market cap of 460 billion on December 2024, right? It was one of the top most expensive companies in the world, not just a healthcare company but across the board among all the companies, right? So it's it's huge basically. So Star Health Insurance, yeah, the Star Health Insurance was started as a startup venture in the health insurance space by the CMD of United Health Group India, right? Yeah, how do I, reduce the zoom? Yeah, this is better. So now the question arises: why do we have standalone health insurance, right? Like we don't see standalone fire insurance companies, standalone crop insurance companies, standalone automobile insurance companies. Then why do we have standalone health insurance companies, right? This question is a natural question which must come to your mind, right? So yeah, I've tried to answer this question that one key nuance of health insurance versus say motor insurance or any other like crop insurance or whatever is that the premium pricing and the sum assured in health insurance would appreciate with time, right? That there is a premium pricing since health itself is a premium product. You cannot have premium pricing in crop insurance, fire insurance, but health insurance it appeals to the psyche of the people, right? They are willing to pay high prices for better treatment opportunities. They are willing to pay for five-star hotel, 5-star hospitals and whatever. You get the gist of it. So also there is a high renewal rate, right? So this, I mean, high renewal rate, you can understand that person takes like health insurance for say 10 years. Now, I will definitely renew the health insurance for the next 10 years as well. It's not that after 10 years the person won't renew. So the renewal rate is almost 100% here compared to say motor vehicle. Like once a person might take automobile insurance when he buys the car, when he first buys the car, right? Since he has sort of an attachment with the car, and as the car gets old, maybe 5 years down the lane or 10 years down the lane, when the insurance cover is expired, you might not buy a new insurance cover, right? I'm not talking about third party. That's legally required insurance, and all car drivers, whether the car is new or old, they need to have a third party insurance. But apart from that, other component of the car insurance, right, regarding the any minor scratches or minor accidents, people don't tend to renew that as the car gets old. But that's not true with health, because we all, even if it's 10 years down the line, 20 years down the line, health remains an important expensive asset, and you are willing to pay even premium prices for an insurance over the health, right? So yeah, so the health insurers in this space have primarily two product segments: the group plans and the retail plan. The group plans are bought by corporates, institutions for their employees as a package. Now, and the retail plans are bought by individual customers for themselves or their immediate family. Group plans bring in higher volumes and revenue, right? Obviously, if the quantity is large, but with minimal importance of brand value. But the caveat is that they have often a lower premium per person and have ironically higher claims ratio. So yeah, that's the caveat. You are giving low quality. It's sort of quantity versus quality thing, right? In group plans, you are bringing in higher volumes and revenue because you are selling insurance plans in bulk, right? Like let's say a company XYZ has 100 employees. Now the Star Health Insurance enters into an agreement with company XYZ that they will sell so and so health insurance plan to all of their 100 employees. So just with one deal, they have access to 100 customers, and they have insured 100 customers, but they cannot, the premium per person would be low since it's a bulk deal and it's a not exactly a retail insurance, it's a group insurance. So the coverage would be lesser, the premiums would be low, and maybe they have seen that the group plans have higher claims ratio. Now I don't know how to explain it, but it is what it is. Coming to the retail plans, these have higher premium per person because a single person is buying an health insurance for his or her own body, right? They are buying a health insurance for themselves, or at best they can buy an health insurance plan for some one or more of their family member. Yeah, that's pretty much it. So small quantities, right? A single health insurance plan sold to a retail customer would bring in a single person, right? So but the cost, but the price at which you will be selling would be higher, so the premium per person would be much higher in the retail business as compared to the group business, right? And the claims ratio is also lower here, and hence this is the better business segment, right? It's obvious that retail health insurance is much better than group health insurance, but the penetrating but penetrating and maintaining market share in retail health ensuring profitable margin requires building trust factor and and brand value also, right? You cannot just go to people and tell them to buy your health insurance product. You have to build your brand image that people trust you, that when in need that they can rely on you for their medical costs and related things, right? They cannot just blindly buy health insurance from you if your brand has no brand value, right? And trust factor. So so retail health is a focus area for standalone health insurers, while group health is crucial enough public and private multi-line general insurers. So as we told that general health insurance companies also sell health insurance, while there are standalone health insurers as well. So what's the essential difference between these two is that standalone health insurers, Sahis, focus mainly on retail business. It's not that they don't have group plans, but their main focus is on the retail business, retail side of things, selling the health insurance to individuals and families rather than to big companies and covering 100 1000 people at one go. That's not their goal. Their goal is retail market, individual health insurance plans. Well, the general health insurers like ICICI Prudential or HDFC, or I don't know which, HDFC Ergo or whatever, I don't know. So these general insurers target group plans in the health segment. They don't really have much penetration in the retail health insurance space, right? So there is that. Well, we can take a look at which are the general insurers in the Indian market. So if you take a look at this, yeah, ICICI Prudential तो उनका वो asset management company है. Basically ICICI Lombard General Insurance Company, Tata AIG, Bajaj Allianz, right? These are the you must have seen the advertisements on TV and newspaper or whatever. So these are the famous general insurance companies. They don't really sell retail health insurance plans, but they focus on group health insurance plans to uh, businesses, right? So there's that. Now, so retail and health insurance has three broad distribution channels. Offline insurance agent, which bring in 86% of business. Now this is, when I first saw this number, I was kind of surprised. Right. Offline insurance agent, that means door to door selling of health insurance, is bringing in 86% of the entire business of retail health insurance. Now this is, uh, I don't know if this is good or bad, but for Star Health, I mean, this is a considerable risk, right? Because it sort of takes away the moat from the business, right? If all you have to do is to hire agents who have to go door to door selling your insurance plan, then anybody can do that. Now, any big company can come, they can start their own standalone health insurance segment business and hire the same agents which sell your brand, and they can pay them higher cost or higher margins to now stick to selling their plan. So what is your, if you are, if the company relies on these insurance agents to sell their health insurance plans, then it definitely takes away the moat of the company. Anyways, the bank assurance is 7% and online aggregators like Policy Bazaar, Acco, etc. These are 7%. Now I hope this is quite self-explanatory. Online aggregators, right? Policy Bazaar, Acco. Basically, these aggregate the health insurance plans from different companies, right? Like one, they will show, they have maintain a list where they will show plans from Star Health Insurance, from Niva Bupa Health Insurance, from 2 3 more companies, and then they will tell you to choose as per your own convenience. They will take a small margin from the order, and yeah, that's what their business model is. So it's quite self-explanatory. Online aggregators, right? Offline insurance agents is also we talked about. Then comes the bank assurance. What is bank assurance? Bank assurance is basically essentially banks, private banks or government banks selling your insurance plan, right? So there's that. Now agent model is a high touch relationship based model where the latter two channels are based on multiple factors like pricing, claim settlement ratios, etc. Yeah, what does means is that Policy Bazaar and Echo usually show the claim settlement ratio alongside the health insurance plan, right? So that the buyer can see भाई इस कंपनी ने कितने claim settle करे हैं, right? So they can take a look at that. So that's the point of claim settlement ratio. Also, obviously किसी का plan सस्ता होगा, किसी का महंगा होगा. Different plans will have different pricing. So based on that, you know, that sort of segregates the different companies and plans. So you have to take care there. While on agency based model, where you are hiring individual agents to go door to door selling your plans, or sort of that model, there this is not a problem. You have to take care that the agent itself is selling your brand only rather than some other brand. Yeah, so there's that. Now wait, I'll have to change the title of my stream, right? Rising Star Health and Allied Insurance stock. I guess that's enough, right? Yeah, so now tailwinds, headwinds. Why tailwinds scared? The tailwinds are something which push your business ahead. So low health insurance penetration provides significant growth opportunity. Obviously, increasing awareness about health insurance post COVID. Yeah, in COVID, during COVID, people sort of uh, felt the brunt of expensive medical costs. So that sort of raised awareness about having a health insurance coverage which covers all the costs related to your treatment if unfortunately you have to have a hospital stay or a hospital visit, whatever. Regulatory push for insurance for all by 2047 initiative. Yeah, so I guess there's some sort of initiative by the Modi government regarding health insurance for all people of the country, right? So there's also a regulatory push from the regulators, which is the government of India. So headwinds, healthcare inflation putting pressure on the claims ratio. Yeah, we'll talk about it when we talk about the claims ratio of the company. Intense competition in the health insurance space. Yep, there are multiple competitors popping up. Almost every month there's a new competitor. That sort of thing is there. Regulatory changes requiring product modification and potentially impacting pricing. Yeah, so regulatory interference is there regarding, since health is a very sensitive subject. People don't really like making health a business. So there's a big regulatory interference in health usually, right? So there's that. 1/n reporting regulation, let's leave it, that's not important for our video. Maybe we'll talk about it when we discuss the actual claims ratio, combined ratio, loss ratio of the company, right? So this is pretty much a you know quick explanation, quick review rather, of the standalone health insurance business. Now now we have to talk about the latest updates and concerns in the company itself. So this we will talk in the next live stream. So goodbye until then. See you later.